Hello, everybody, and welcome to our session. Thank you for the introduction, Shireen. And we are now moving on to the Investing in ASEAN session, the perspectives from global financial institutions. I am absolutely delighted today to be joined by two experts, Diana Tang, who is a Director of Sustainable Finance in APAC, ING, and Adrian Rimmer, who is from the London Stock Exchange Group. And they are both going to bring us some really interesting perspectives on the region. As we know, sustainable finance has really taken off in Europe, being the home of sustainability and sustainable finance. We are now seeing a growth in particularly green finance around the world, and specifically in APAC. So I'd love to just introduce you quickly to our panelists. Adrian works for LSEG in sustainable finance and capital markets, and he works with the customers to support their transition to sustainable and low carbon business models. Diana is a director in ING's APAC Sustainable Finance team based in Singapore, and she's responsible for the origination and structuring of sustainable finance solutions for corporate and institutional clients across APAC. So welcome both of you, Diana and Adrian, to our panel session today.
Thank you.
Nice to meet you.
Right, I'm going to kick off, and I'd like to ask you both just a really quick opening question, kind of set the scene. Diana, let's start with you. How is ING working to ensure that its green and sustainable financing innovation strategies not only support the transition to a low carbon economy, but foster inclusivity and resilience across Asia's diverse economies?
Yeah, thanks for the introduction. I think when we talk about green financing, sustainable financing, traditionally there's been a lot of focus on the E part of the E, S, and G. I think what we're trying to do is really to consider the S elements. Even when we're doing, let's say, a green project, if it's a renewable energy transaction, if it's a construction of a hydropower plant, for example, we need to consider the social elements besides the governance. So for example, looking at the impact on the community surrounding the project, besides providing employment opportunities, the more serious issues are, what sort of impact is it driving for the communities? What are the grievance mechanisms? How do companies and projects address that? So it's an inclusive approach where we're not just looking at the environmental elements, but also on the social justice points. We do have frameworks in the market, such as the Equator Principles. I think it provides a consistent set of approaches for banks, for lenders, and for investors to look at it from this lens. The second point I'll talk about quite quickly is really about the growth of sustainable loans and bonds. So when we say sustainable in the loan and bond market, it really means green and social. We're seeing an increase in the social issuances from both loan and bond perspectives. And this is really driven in ASEAN. You see there's a lot of investment in infrastructure, etc. How do we classify this? I think there's a lot more thought in the market as to how investors look at this, but happy to expand more later.
Thank you. Adrian, so if we just come on to you, LSEG plays an important role in connecting global capital markets and the emerging markets. I mean, it's a really kind of a really core role that it plays. So what are the challenges that Southeast Asian companies face when they're raising capital? Because obviously the regions are really quite different.
Yeah. Well, and I think you've hit the nail on the head with exactly that point. This is not a homogenous region, and we need to look at a range of issues around the availability of consistent data sets, some very practical issues which we talk about around FX, and really ensuring that investors that have want exposure either to the region or thematically from other markets around the world can deploy that capital effectively and efficiently. And I think one of the roles that we like to play is really both in terms of ensuring that our markets are fit for purpose. We have investors from all over the world deploying capital via London, but into geographies everywhere. But also other parts of our group are very much focused on ensuring that the There are data sets available for investors to compare and contrast investments, to understand them, to perform due diligence. And so the role we play helps to kind of address some of those key challenges around understanding how capital is going to be deployed, how that is hedged, how you can bring together vehicles that can aggregate thematic investments. And we'll talk about some of those later. But I think it was great to hear Diana talk about the just transition. And it's certainly something that we have a key focus on when we're thinking about some of the new areas that we'll talk about later around carbon markets, for example, and how they can be leveraged, but not only to attract capital, but also to ensure there is that communities benefit from the financing that takes place within countries.
I think that's a really interesting point to touch on, because the data sets around social become quite challenging. It's not quite the same as climate, where you can get a lot more consistency. Perhaps what we can do for the next half an hour or so is just focus on maybe some of the opportunities and then some of the challenges that we're facing in the region. Now, the Southeast Asian nations risk underinvestment if their transition, if they cannot attract the capital from outside of the region. Diana, what policies and regulations are needed to create this sort of environment? What are the opportunities that you see at ING from countries that you're not currently active in, or even you're active in before lending to these various projects?
I think one of the keywords I would use would be consistency. When we say consistency, I think that relates to a consistent approach on policies and regulations. Whenever there is a lot of uncertainty, we do observe that financing timelines get delayed, projects get postponed if there are delays on things like permitting, etc. Within the region, we are seeing very good numbers coming up from certain investments in certain sectors. For example, in the Philippines, investments in clean energy has really surged. Some of the supportive sort of policies that we're observing would be they have incentives for financial institutions to deploy more funds into certain sectors of the economy. They have got policies to spur sustainable finance issuances, because one of the questions we do get quite often is, why are there not more capital incentives to lower the cost of capital if the transactions are, to facilitate transition, whether it's in energy or decarbonization initiatives. So we do see certain sort of supportive policies to attract sustainable financing. In the Philippines, the government has come out and said, if you issue a sustainable bond, you can lower the capital reserve requirement from 3% progressively to 0%. And that then, starts people thinking, look, how do I tap into such measures to help drive, activities? From a other perspective, I would say we need to consider maybe how we can bring in additional sources of liquidity into capital structures. I think one of the points that Adrian's touched on is how do you bring together different sets of vehicles. So when we look at the funding structures, a lot of the financings within the region is still very bank driven. So it's provided on bilateral basis, clubs or syndicated loans. If we look at financing massive infrastructure and transition investments, how do you actually have an equitable share of the risk? Perhaps in the beginning, when the risk is higher, you may have certain banks co-funding alongside multilaterals. And we can talk a bit about, I think Adrian will touch upon maybe some other points in terms of credit enhancements. The reality is there could be other sources of liquidity who wants to invest, but they may not have the capacity to be doing due diligence on every single project out there. So what you could then have is, after a few years, maybe when the project is already operating and the risk is lower, could you do securitizations, bring in innovative financing mechanisms, spread the risk out, get more players coming in, free up capital so that we're not locking in capital, free up the capital, let others come in and participate, and you then broaden the entire pool of financing that's available. So those are just some considerations.
There's obviously quite a lot of challenge to match all these different markers, but there seems to be some real innovative things happening. Adrian, if we think about credit ratings, they continue to hold emerging economies back from accessing cheap capital. And, Diana's already touched on some actually of innovation to try and encourage people to come in with their capital. What role do guarantees play in helping country finance that transition? And can you tell us more about the Green Guarantee Company, or the GC, another acronym in this wonderful world of acronyms, and what you think this might achieve?
Yes, of course. Yeah, guarantees do play a really valuable role in this market, and actually, the Green Guarantee Company is a really good example of that. And literally was almost exactly a year ago today that was launched here at the London Stock Exchange. What's interesting about that is today I just came before this session from the launch of the Climate Investment Fund's Capital Markets Mechanism, which is another mechanism by which we're looking to, or the World Bank in this case, is looking to accelerate climate funding by sort of front-loading future reflows from other parts of their market. So we see, I guess that's a really good example of how innovation is just consistently occurring in this market to try and make capital flow. But the GGC in particular is really about providing investment-grade guarantees to improve the credit ratings of borrowers in emerging markets. And so by doing so to be able to crowd in private capital. So they launched and they had an initial $100 million of capital from organizations like the UK Foreign and Commonwealth Development Office, from the Green Climate Fund, and a number of other countries. And their goal is really to provide $1 billion worth of guarantees, or to finance $1 billion of capital flows against that. And so, and again, the way that's been designed is to cover both a variety of public and private debt instruments. So, the sort of green and sustainable bonds we're very familiar with, the use of proceeds bonds, but also project bonds, securitizations, sukuk, which is very important, particularly in the ASEAN region, and private placements. So really to look across a wealth of debt instruments, and with a focus on climate investments across, again, the full spectrum of activities from energy access, buildings and industrial decarbonisation, as well as a small portion allocated to things like land use and forestry. Focus countries in ASEAN terms: Indonesia, Philippines, Vietnam. So we're seeing the right level of focus. And I guess the way that it works is essentially there are partners to the GGC, which originate transactions. And then there are a number of stages of review that goes through. So review and challenge, due diligence, and importantly, assistance provided to address any gaps that are identified. So again, capacity building is really important. And that's important that they are part of these processes to help ensure that the next transaction and the next transaction are stronger still. And ultimately, they will then provide a guarantee based upon that. So that's extremely helpful in crowding in private sector investment. And it's reflected in what we've seen, both those transactions that are guaranteed, but more generally in Asia, it gives confidence to a market more broadly than just the guarantees are allocated. We now have over nearly 140 bonds in the Asia Pacific region, including ASEAN, that have raised over $57 billion. So we see that as an enabler that's really important. And it's not just GGC; there are other guarantees facilities as well, but they perform a key role in enabling access to capital from around the world.
Great. I'd like to also just stay on challenges at the moment before we move on to some of the opportunities, because you've already talked very optimistically about some of the challenges and actually how they're being addressed. But Diana, if I come to you, what would you say the largest challenge in the region is at the moment in terms of galvanizing capital?
When I mentioned consistency just now, I think Adrian's touched a couple of points on data. One of the key challenges would be if you look at who's putting money, into projects across the region. These investors are based in many, many countries across the world where they now have mandatory disclosure requirements. So if they're going to invest in something, they need to be able to measure. When I say measure, it's not just about the financial implications, but it's also about the ESG implications. This is not even anything to do with sustainable financing, because this is not about green or sustainable financing. If you want to have financing, you want investments, you will need to be able to provide the underlying data. So I think that's one of the biggest issues. If people invest and they can't really tell, and from a legal perspective, they now need to disclose. It just means that they're going to mark out the investment and say, look, you don't have the data that I need, and I need it for regulatory reasons. So a lot of companies now have to start preparing. How do you measure it? What protocols that you're using? What methodologies you're using? You need to ensure that this is easily understood. It's accurate. It can be relied on.
That's great. And Adrian, from your perspective, you've just talked about some of the tools that are being used, but are there any really big challenges in terms of that you see from your perspective, Elseg?
Yeah, I think what we still see is a need for ongoing education of bankers, both in developing markets and actually in developed countries too. So we see that a lack of expertise. There are some great and very experienced green bond teams now. That's become quite mainstreamed, and therefore most banks have that capability and are more experienced at that. And we're seeing the benefits of that in terms of scaling up. On the equity side, not so much. And so one of the things we spend a lot of our time doing is really helping convene different groups to help them share both the perspectives on what the challenges are, but also educate them, bringing together those that have real strong expertise regionally or in particular thematic areas, and helping them understand that. I think that capacity building of expertise, of experience, to make it easier to do these deals than to do an alternative, less green deal, I think is an important part of that. And risk appetite is something that will really help address that. Banks, as they start to think about requirements for data, requirements to see transition plans, that will feed into credit committees, and that will mean that people have to understand those factors, and it will be harder to do deals that don't have those. So I think, exactly as Diane was saying, there's a sort of carrot and stick here, in terms of creating incentives and guarantees that provide flows, but also requirements that will ensure that those seeking capital have to provide additional data is going to be critical.
So I've got a cheeky question I'm going to throw in here. Neither of you have been prepared for this, but I think it's really hard not to talk at the moment in sustainable investing and sustainable finance, not to mention the change of regime in the political regime in the US. Do you think that's going to impact, very briefly, do you think that might impact anything positive or negatively, given the anti-ESG and green sentiment coming out of the Trump administration? Diana?
I think from my perspective, if we look at maybe some of the suppliers in the region who are part of the value chain of some of the companies who might be implicated, I think you might see certain contingencies that they will need to plan for. But if you look at the region itself, I think what's quite encouraging to see is, the need for energy is strong. The population is relatively young. There is a lot of domestic demand. If we look at energy security, a lot of the countries themselves, they themselves need the energy, and it's not just for exporting industrial processes, EV transition, etc. A lot of it is going to be intra-ASEAN, intra-Asian as well. So there will certainly be implications. But when we look at ESG and transition planning, it is what they're going to have to do for business anyway, regardless of who's in the regime. They will need to plan for it.
And that's quite a lot of people I've been speaking to in the industry at the moment are reiterating the same thing. We still need to transition, and there is still a big green movement. Adrian, from your perspective as a global company and obviously with a big American presence, have you got any takes on whether you think this is going to be a good or bad or slow things up?
Look, I think ultimately, exactly as been said, the reality is renewable energy is a cheap form of energy now, right? So if you're looking to provide energy to your population, it's the obvious part of your choice, right? So notwithstanding, the ability to, in certain markets where there's plentiful coal, the reality is in most markets, wind and solar are the cheapest form of energy. So I don't see that slowing down. I think, between Europe and Asia and China in particular, you're going to see, again, a continued focus on those greener industries. And we're also seeing a real focus on getting data. So ISSB regulation associated with providing, again, this is climate data rather than social, but I think we'll see that pull a broader swathe of ESG data requirements through in terms of mainstream reporting from companies within the region. And so it's going to be a requirement if you're trading into the EU. It's going to be a requirement if you're working with most international companies still. They want to understand risk in their supply chains. So I see there are some obvious places where finance may not flow, in terms of areas like the Green Climate Fund, where there may be, there's some of its access to capital from the US may be constricted for some time. But the reality is the commercial incentive around this exists. People want to transition. People want to move to lower carbon business models. They need to report. And so the reality is we'll see that continue. And I think there really is potentially an opportunity around this as well, which is to make these disclosure requirements more appropriate to different regions. Often it's been large Western companies dictating the disclosure requirements. And actually, there's an opportunity now to move sort of ground up, really, to say, well, actually, this is what's material from the perspective of the producers of these products and raw materials, and maybe to improve the sources of data and the types of data that are disclosed as well.
Brilliant. Thank you so much for that. Now I'm quite keen to kind of really focus on some of the opportunities that we're seeing in the region. So just a really simple question for both of you. What are the most attractive sectors in the Southeast Asia at the moment for investment? Where are you seeing those? Where are you seeing the real opportunities lie? Diana, do you want to touch on that one? And then we'll give Adrian a chance to answer.
Sure. I would be remiss if I did not mention digital infrastructure from a financing perspective. There's a lot of transactions out in the market. There's a lot of talk about it. So I think infrastructure as a theme is quite key. You've got the usual transport infrastructure. When we look at roads, the investments being made into roads, rail, maritime. It's something that sometimes we don't talk enough about. There is a lot of focus on decarbonization of those sectors. How do you bring in more clean transportation to support the theme of the increased urbanization trends across the region? How do you get some cars off the road, put rail in, put metros in? It's not perfect, but you need to think about that. From a digital infrastructure perspective, I think some interesting themes is obviously data centers, top of mind for many investors and lenders in the region. But besides data center, I think we would talk about the rollout of fiber, also the shift from 4G to 5G. When we talk to corporates and FIs around the region, we discuss the implications. So if you have got 4G to 5G or you roll out fiber, you do enhance digital inclusion. You do see in certain countries in ASEAN, there are certain constraints in terms of access to perhaps healthcare. And through the use of tele-consulting, you're able to manage some of this and drive some of these benefits. We see that I think in 2024, some interesting statistics that we saw was the Southeast Asian region attracted more than 30 billion in AI infrastructure investment in the first half of 2024 alone. You start seeing more sea cables because of the need for data. It's a young population, very internet savvy. And very high smartphone penetration rates as well. So these are some of the attractive areas. We did not talk about renewable energy, but I think we spent a lot of time talking about renewable energy today.
Great. What's your take, Adrian? Where are the opportunities?
Well, I'd echo that, and obviously Diana's, at the forefront of actually providing the capital. We provide the venues that capital is raised through. I think I would just add to that, and I'd certainly endorse the piece around AI and digital infrastructure, really as an enabler to a lot of sustainability solutions. What we've seen is real interest on the equity side here. So we talked a little earlier about the fixed income markets and the growth and the spectacular growth we've seen in sustainable bonds and vehicles. But actually on the equity side, we're seeing a lot of interest in vehicles like listed investment trusts that can invest into underlying illiquid assets. So exactly those things: renewable infrastructure, transport, etc. So they provide investors in London with a liquid investment vehicle, an equity vehicle that is in turn investing into infrastructure. So it gives them liquid access to an illiquid underlying investment. And again, those have been hugely successful. I mean, they're a 120, 150-year-old instrument, and were used to finance a lot of the infrastructure in Europe and the US back in the day. And I think we're now seeing those applied to emerging markets in a really meaningful way. And I think that's quite an interesting development in terms of the way we're seeing that growth.
Sorry. You've also touched on technology. Diana, I've got a couple of questions for you. The first is you talked about the growth of data centers, which is interesting, but we also know how carbon intensive data centers are. So any technology innovation to help with that, but also, in your view, what can technology and innovation do to contribute to make projects more financially viable and attractive?
If you talk about data centers, I think what's also interesting is it is in turn driving the take-up of renewable energy around ASEAN, because a lot of the off-takers, especially the hyperscale ones, they have a strong focus in saying, look, I will only take a project up if you can give me renewable energy, because I'm going to need that. I need high reliability. But what we also observe would be how they bring others in the supply chain. So it depends on which sectors we're talking about. If you have got some TMT players who are off-takers of such data centers, they might come in to procure large amounts and confirm, look, they will backstop the purchase of renewable power, but they also want to do it at a price that is attractive for their suppliers. So they bring their suppliers with them. They provide such access to other ecosystem players by leveraging on their strength as a large purchaser. So we do see some interesting schemes. This is where, when we say disclosure, it starts becoming very tricky if you talk about supply chain, but these are some tangible ways as to how some of these players can innovate and make certain projects more viable by providing access to either a lower or more competitive cost of financing or cost of funds or operating costs for their supply chain. So that's one example.
Great. I mean, LSEG is not in necessarily the trading side of things in terms of actually allocating finance, but you're there to facilitate the finance. Are you seeing anything from your perspective that where technology can really help with moving that capital into more transition companies?
Yeah, I think we're very much seeing that. So one of the things that my colleagues in our FTSE Russell business have done is create a what we could call a green revenues data model. So as part of the ESG data that they gather on companies, they gather data on green revenues. Now, that's really important, because this shows where the rubber's hitting the road, in the sense of which companies are making revenues from green products and services, and not just the kind of obvious renewables type stuff, but a wide range of different activities. And it allows investors who have a thematic interest in supporting these solutions to start deploying capital. We applied it on our own market to create a green economy mark, which is an equity classification for any company that makes more than half its revenues from green products and services. And we're seeing that applied in other markets as well. I think that's a really helpful piece of data to track alongside the kind of the capex and opex in these areas. But also, I think there's some other interesting areas. So Bursa Malaysia, to take a good example, has launched a platform called Sustainability Intelligence. Now, what's really interesting about that is that, actually, this is something we developed for them, but this allows their companies listed on the markets to disclose in line with ISSB. So it actually helps them disclose more easily against the requirements that are coming into that market. But really importantly, and to the point that Diana was making, it is a way that those companies can ask for data from their supply chains, and they can ask those companies if they want help. So it actually enables them both to seek accurate Scope 3 data, for example, and build accurate Scope 3 data by asking direct questions for data from those companies, but also to say, look, how can we, as a major customer of yours, provide and support you to decarbonize your business, for example? And so it really starts binding those supply chains together in a much more robust way, helping strengthen those and using the balance sheets of those very large companies to support the decarbonization of smaller companies and support the capacity to make change within those companies. I think those are really key areas where technology can make that possible, where it would have been almost impossible prior to that.
Great. I think that's really interesting, and it's really interesting to see how technology can be helping drive some of this, some of the finance in green and sustainable activities. Now, Southeast Asia is home to two of the three, Malaysia, Indonesia, and Philippines, world's 17 mega diverse countries. So this is moving a little bit more in less about clean energy and more about biodiversity, which I think is an increasingly interesting area for investors. So with the operationalization of Article 6 announced at COP29, what opportunities will the carbon markets create in attracting investment as well as protecting biodiversity in the Southeast East Asian region? Specifically, Diana, financing, cross-border financing in this region, and the different activities that are happening. Perhaps you can touch on that and give us your views.
Okay. From a financing perspective, I think obviously there are investment opportunities. You see a lot of demand coming from companies. So you do see a lot of corporate participation because they themselves have got net zero targets. So they could be potential investors of projects themselves, or be the buyers of any credits or offsets that are generated. From a financial incentive perspective, there's an opportunity to create more equitable sort of benefit sharing with the local communities. If you've got consistent sets of standards across the region globally, you do see a bit more financial incentives to perhaps protect these ecosystems. A lot of the local sites are generally safeguarded perhaps by local communities. How do you bring them in? What sort of opportunities do you create for those? Alongside community engagement and participation. One thing maybe I would also like to highlight would be with the operationalization of Article 6, we do think that there is actually, it's a positive driver to perhaps drive a bit more political will at the national level, to do a bit more mapping to see what opportunities there are. And consider how they may integrate this into legislation. For example, I think we observed from the UK, they have a biodiversity net gain law for any new developers who are looking at perhaps infrastructure projects, housing, etc. They actually now need to ensure that the projects result in a 10% net gain in biodiversity. And it means that the natural habitat must be left in a better state than prior to the development. So this then matters because it raises funding for conservation, etc. We think this could be an interesting theme to watch in the coming years.
So from an LSEG perspective, Adrian, we touched on biodiversity, but perhaps you can bring in some social elements as well, because these are two kind of growing areas of interest. What are the emerging social issues? And often that's linked with either climate change or biodiversity. And, how is LSEG addressing that within its...
Yeah, so I mean, I think that's the really exciting thing about carbon markets as a financing tool, right? So fundamentally, they are about results for delivery of decarbonisation activity. But on top of that, these projects have to, through the rules that are built around them in terms of the way that they are designed, built and managed, they have to maximise or look for ways to maximise social and other environmental co-benefits, as they're known, and to ensure that those the communities in which the projects take place are benefiting from those activities, and have a say in how they are designed and managed on an ongoing basis. So the way that standards have been built around the carbon markets from the very early days of the Kyoto Protocol and the UN Clean Development Mechanism through to what's been really the only game in town until recently, the voluntary carbon market, which has a huge role to play and is already playing a huge role in ASEAN countries as elsewhere. And then the operationalization of Article 6, which really creates a proper international regulatory framework that's been sorely missing, it has the opportunity to really create scale around that. Now, I would say, and to the point that Diana made as well, this is a huge source of capital. Now, Indonesia has vast carbon stocks, and it is providing those are providing a service to all of us. So it's right that there is a value put upon those stocks. It's also a source, and the Indonesian government is actively looking at ways of using carbon finance to support reforestation. So not just conservation, but reforesting areas that have been lost previously. And again, carbon finance can deliver that and really support the communities in involving them in delivering that, managing those forests, ensuring they are biodiverse, ensuring that we're not creating monocultures, but actually we're creating livable, productive land. And then around that, you've got new methodologies around agriculture and other forms of land use. So again, they directly support communities in the way that they're done. But more than that, you've got an opportunity to use carbon finance to attract in capital. So it's not just about carbon stocks and putting a value as you would the coal beneath them, but it's also about looking at attracting finance to industrial decarbonisation, but also energy access. So you'll gather from my enthusiasm here, this is a mechanism that has huge potential, but also the governance that's been baked in. There is criticism of carbon markets, but often that comes from those who don't really understand how markets work, and all of the depth of data that is gathered and required to be gathered around the way that projects are managed. I mean, we can improve upon that. We talked about technology. I think digitization of data, digitization of monitoring, reporting, and verification, combining satellite data with on-the-ground proofing of data, and community engagement, all those things together can make that system stronger. But it is a vast source of finance that can touch communities directly, and allow them to really add a new income stream to the way that they are living their lives, and improve their access to all sorts of services. So, we're very excited about that. We created what we call our carbon market designation, our VCM designation, which is for equity vehicles that are investing into carbon projects. And the purpose of that was to use the vast pools of capital in London that want to be deployed into climate action, to be deployed in emerging markets and developing countries, but do so in a way that gives investors greater transparency of what's being done, some eligibility criteria around the types of activity, and ensuring these social benefits, for example, are delivered, and that any claims made associated with them are delivered upon and measured associated with the way that the investments are gathered. And then to distribute dividends in the form of carbon credits to investors. So suddenly you can crowd in corporate capital from those companies who have a compliance or a voluntary commitment to buying and compensating for their emissions. So, really, I think the key thing here is, how do you take a nascent but really powerful tool, leverage the engagement of the UN's mechanism here, and then link financial infrastructure and public markets governance to make these things really work at scale. So it's an exciting time for that market.
That is brilliant. And it actually brings us to the end of our session. So we've got 2 minutes. So you need to be quick, but I'm going to ask you a final question before I wrap up. And that is, in 60 seconds, what would you like to see change to unlock investment in the Southeast Asian region? Diana, go first.
A lot of things on my wish list, but I think a regional power grid in ASEAN is something that I think would unlock investment. Right now, with growing energy demand in the region, if there is a regional power grid, and you do see certain projects taking off between different countries, we would see. I believe that we would see this attracting more foreign direct investments, because if there is an uncertainty in the stability of availability of power, that creates a lot more uncertainties.
Great. Regional power grid. Love it. Adrian, what have you got for us in 60 seconds?
Firstly, I couldn't agree more. I think that is that infrastructure is key. I'll take it back to data in that case, which and really talk about things like leveraging things like the GEMS risk database. So looking at ways in which we can aggregate information from the success rates and the risk associated with lending into emerging markets, developing countries, make it available and accessible and consistent, so that investors can actually look and see whether the credit ratings they're applying or the credit risk factors they're applying are appropriate, and hopefully identify the fact that often we're over-allocating or over-allocating risk to these activities and countries, and more finance can flow if we can do better credit ratings.
Brilliant. Diana, thank you so much. Adrian, thank you so much, both of you, for joining us. It's been really interesting. My key takeaways is, a drive for consistency, clearly from a data, but also reporting mechanism is key. And I think we'll definitely see a much bigger convergence. We've clearly got the other key takeaway for me is some real innovation happening in the region to try and galvanize capital. And it's great to see some of the governments in the region really trying to think innovatively in terms of how they can get foreign investment in not just to clean energy, but to support biodiversity and social communities. So thank you very much for joining us at this session. It's been a great time to chat to you, and we will hand over and conclude today. Thank you very much.
Thank
Thank
you very
you.
much.